So towards the end of 2020, institutional and private investors were asking us where there were going to be opportunities to acquire high-quality industrial investment properties in 2021. And one of our top answers was sale-leasebacks. "2020 forced companies to evolve on how they assess their real estate holdings as it relates to their core business. And because of the impacts from COVID, the volume of sale-leaseback transactions and the trend towards owner-users embracing the concept was anticipated for two main reasons. One, in Southern California, there's significant value and equity built into the property for the owner, and in some cases, significantly more than the business may be worth. But depending on the circumstances, keeping the business running after the sale of the asset is crucial. A sale-leaseback allows the individual owner of the property to monetize the asset and in many cases, take significant proceeds from the sale and reinvest the money with a variety of options. Invest it back in the business, upgrade equipment, etc. Or in many cases, we see sellers use sale-leasebacks as an opportunity to diversify their own real estate portfolio. As opposed to a business owner owning the facility as an LLC and the business leasing the asset from the LLC, we've actually seen sellers take proceeds from the building sale and reinvest them in leased assets stabilized by other companies to diversify their sources of income between the business and other investments. Now, from an acquisition standpoint for institutional investors and private investors alike, sale-leasebacks are an opportunity to unlock value. At its core, it's a manufactured, long-term leased investment. There's no vacancy at close. Because the leaseback with the seller's company is executed in escrow, but in certain circumstances, the exact structure and economics of the leaseback and the sales price are negotiated hand in hand during the process. The seller's business has to support the rent and terms agreed to in the leaseback, so in some cases, the result is an under-market rent, which allows the buyer to underwrite future rent growth above and beyond the initial lease term. And because the lease is in place at the close of escrow, there's no vacancy risk. The seller has typically disclosed all financial information about the business prior to opening escrow, so the risk profile for the buyer is typically lower, which in most cases supports a lower cap rate on the leaseback rent and a higher sales price for the seller. The building behind us is exactly what we predicted would be possible in 2020 and moving forward and looking forward to 2021. We exclusively represented the institutional buyer in this sales leaseback transaction, totaling just over 232,000 square feet for $38 million. This deal was a mutually beneficial opportunity for a buyer to secure a brand new construction, fully stabilized, high-image industrial leased investment, and for a seller to take significant equity out of the building, reinvest that money back into the business, all without disrupting the operations or forcing a move. For more industrial capital markets and leased investment opportunities just like this one, please contact me or our team.